Due to the easy availability and access to information, we are hounded by opinions and advice on investing. In fact, this abundance of information also leads to a lot of misinformation and ill advice being floated around. It is only human to fall victim to such misinformation and at some point in our lives as we fear missing out what others around us are doing. Hi, I'm Purav Shah and welcome to channel Dezerv. In this video, we are going to talk about few common investing myths and what you must know about the truth. We are doing 3-part series on common investing myths, and in the first part of the series, we spoke about 2 investing myths that are very common but absolutely wrong. Watch on as we debunk 2 more common investing myths and separate facts from fictions in the second part of this series. Coming to our first myth, the most used investment advice, that is buy low and sell high. Waiting for the price of the stock to fall before you invest? Think again. Investors, especially early investors, often have this belief that buying low and selling high is the most effective way to invest. While this theory sounds obvious, it must be remembered that investing isn't so straightforward. You must be cautious about 2 aspects when considering this theory. Firstly, no one knows for sure how well the market will perform over a period of time. If we did, you wouldn't have such few millionaires. So trying to determine if the stock price is at its lowest or high in a bid to buy it at the perfect time can only work if the investors have extensive knowledge about the stock. And even then, it is extremely rare to time it to perfection. Secondly, be cautious about your time horizon of investing. Don't try to time the market or be short-sighted. To understand better, compare 2 investors who have investing monies in companies with strong fundamentals and the other who constantly looks to buy low and sell high. History and data suggest that on average the latter would not necessarily do better than the former. This is because the maximum realization of returns occurs when investments are made over the long term, and even if someone does manage to time the market perfectly, any excess returns that are generated will only be small. So the only solution is to invest for a long time and be patient. Moving on to the next myth, let's talk about the 60-40 rule. For decades, investors have used the good old 60-40 rule to plan their financial future. Using this thumb rule, investors put 60% of their money in stocks and the rest 40% in bonds. This formula, which was once widely used, is supposed to show relatively stable long-term growth, with bonds balancing the risk of stocks. But just like the 100 minus age rule that we discussed in the previous video, the 60-40 thumb rule is quite outdated. The investing landscape has completely changed over the last 20 years, and the 60-40 rule is no longer relevant as it fails to offer true diversification of the portfolio. The main reason for this is that bond yields today are minuscule compared to the yields in the past. For example, over the last 10 years, bond yields have been hovering around 6 to 7%, while returns from stocks with good fundamentals have outperformed bonds with returns of around 9 to 10%. As a result, such a broad generalization of portfolio planning is no longer relevant. A healthy mix of equity and debt instruments that are aligned to individualistic goals and aspirations is the need of the hour. Now that we've debunked a few myths, let me summarize the learnings from this video for you. Invest for the long term. Staying invested for long term increases the compounding effect of money and your wealth has enough time to grow. Diversify your investments depending on your requirements and risk appetite. Don't rely on set rules and ratios. Hope you found this video useful, and if you have any questions, please put them down in the comment section below and my team and I will address them for you. Hit the subscribe button below and press the bell icon to watch the next part of our series on debunking common investment myths. Thank you.